be sure to know that this next speaker, by the time he's finished, you will have a better relationship with money. Please give a warm Legacy family welcome to Garrett Gunderson.
So today's going to be a little bit different because we're talking about tax, and you guys know what's funny about taxes? Nothing. No, taxes suck, right? They say there's only two things you can count on in life, death and taxes, which seems a bit redundant since most of you would rather die than pay your taxes. The government calls it a voluntary system. Yeah, you voluntarily pay or voluntarily go to jail. But at least we know our taxes are going to good use, right? I mean, in my home state of Utah, you know there's a thing that if you're over age 65, you can marry your cousin. Because, well, of course there is. I mean, it doesn't say how old she has to be, so that even seems creepier, right? I mean, this is an actual law that's been passed. You know how much time and money it takes to have a session with 75 state representatives, 29 state senators? Someone proposes the bill, then someone has to actually write the bill, then they amend the bill and debate the bill, and then have the governor sign off on it. Also, some 65-year-old perv can marry his cousins. And yeah, I went with cousins because it was Utah. Go polygamy and go Utes. Yeah. Yeah, but we get some tax breaks, right? Like I have kids, so they're a tax break because you bought future revenue opportunities to the government in the form of taxpayers. But the joke's on the government because my kids, well, they don't work. So we're going to talk a little bit about taxes. I might add a little bit of humor like that as we go through this, but what I want to make sure to really do is give you really practical things that help you keep more of what you make legally and ethically. Because look, you can make money, which is with your income. You can grow that money with investing, but there's a lot of opportunity to keep more of what you make without having to cut back. Most financial people want you to reduce, eliminate, cut back, don't increase your quality of life, but that sucks. That's going to slow you down because that creates a scarcity mindset. And scarcity is the greatest destroyer of wealth. No amount of luck, saving, discipline, rate of return, or financial advisor will save you if you're in scarcity because that repels wealth and doesn't build it. I want you to think more about being a productive person than reduction thinking. Produce instead of consume. Like, what can you do to add more value, serve more people, solve bigger problems? And ultimately, there's almost no bigger line item of expense than taxes. So if I can help you reduce that, you can reinvest that back into your quality of life, into employees, into your business, whatever you want. And I will promise you, whatever you spend it on, it'll be more efficient than where it's currently going. Right? Or are you guys big government fans and want to just... the government's so good with money, they're $30 trillion in debt. That's a 30. How many zeros do you think follow that? For 2 years, I said it was 18 zeros. It's 13, but people don't even know at that point. It's it's a bajillion million dollars. People don't even know what to think about it. Man, that's crazy. You know how long it takes to count to a trillion? 32,000 years. You know what was going on 32,000 years ago? An ice age, Neanderthals were just around, Joe Biden had just been born. I mean, I'm not going to give you the type of tax advice that a lot of people give either, which is more about delaying tax, because there's a big difference between delaying tax and saving tax. Most people's 401k looks like a 201k when they go to take their money out of it. Because saving tax means you don't have to pay. Delaying it means you don't have to pay right now. Because who doesn't want to wait till they're older and crankier to finally pay their taxes? That's why I think retirement plans are crazy. Who wants to wait till they're 85 to finally enjoy life? Go jet skiing when you might break a hip? You're not going to get crunk up in the club when you're 85? Shit, I can't even do that today. The only thing that happens when you're 85 is you wake up. And some days you wish that wouldn't occur. Your body aches, your eyes are swollen shut, and now you got to go be president, right? Oh, God. I'll actually get to some content in a minute. We're just going to make fun of taxes for a bit. All right. So let me create some context before we get there. How many people here have ever heard or even said that you should live within your means? That's good advice. But there's 3 ways to live within your means. The first way is to reduce, to cut back, to budget. And unfortunately, that is not the road to wealth. No one shrinks their way to wealth. The second way is to be more efficient within your means. There's 4 ways to be more efficient, or the 4 I's. One is the IRS, stop tipping the government. Like, look, I like tipping. It's a great way to say thank you, job well done. Not something I associate with the government. It's like tipping a waiter who ate 37.5% of your meal and peed in your soup. I've been doing a lot of comedy, so I can't help myself. It just happens. So number 1 is the IRS. That's how we be more efficient, pay them less legally and ethically. The second is interest. You know, if you have the right credit score, the right collateral, the right cash flow reporting, or the right connections, you're going to pay less in interest and therefore keep more money rather than give it to institutions. The third I is investments, especially investments in the traditional sense where people are giving their money to investment advisors that they know nothing about the investments they're getting into, but they're paying a lot of non-performing fees, a lot of expenses, and unfortunately not protecting their downside. And ultimately, I'm here, like this is just a personal opinion, but I'm here to basically tell people to never invest in the stock market ever again for the rest of their life. Let me just get on a soapbox for 1 minute here. First off, there's a fiduciary responsibility for publicly traded companies only to the shareholders, not to employees and not to customers. So we continue to see something wrought with fraud where they continue to do things on the backs of employees and not helping them and hurting their customers just so they can get more, so they can continue to raise their stock price so a bunch of hedge fund assholes can get even more rich. Like, I'd rather vote with my dollar than go vote for someone who's always going to be inept when they get into politics. Like, and when we vote with our dollar, why vote for companies that you would never want to do business with? I believe you should invest in yourself, in your skill sets, in your aptitude, and in the investments that you create cash flow, not accumulate. This notion of accumulation is a stupid, antiquated, old philosophy that says, hey, buy a mutual fund, put money away often, early, and always. Set it and forget it. Wait for 30 years, and then one day, someday, you can finally enjoy life when you're too old to enjoy it, like I said before. It's a crazy notion. I believe in the things that Jeff was saying, economic independence, where you have enough cash flow coming from your balance sheet to cover your basic expenses, so every active dollar you earn can buy more assets. That's 10 times better than this notion of retirement plans. Well, I'm going to take 10% of my income and try to earn 10% on something that's not going to produce 10% because we're still stuck in the 90s, quoting in returns that don't even exist today, and pay a bunch of investment fees to people who can make money whether you make money or not, so that one day, someday, you can be told only to live off the interest. That's a dumb idea. Let's build up a bunch of assets and only live off the interest so the institutions can lend that out over and over and over again through fractionalized banking. Not that I have an opinion or any passion towards this dumbass shit, but ultimately, the whole notion is they try to tell you it's complicated, you can't understand it, and you need to trust these other people who are merely salespeople that pose like planners. Planners are going to say, are you saving tax? Have you have the proper asset protection? Or what are you really good at? Let's make sure you invest in that. They're not going to try to talk you out of your real estate deals. They're going to encourage that if that's where your expertise is, because you all have investor DNA. Investor DNA is your values, like what matters to you. That's your script for how to operate. It's your competencies. What are you good at? It's their drivers. What things do you want to pay attention to? And the rule is focus, don't diversify. Diversification is diversification when it's spreading up against a bunch of different stocks you know nothing about. Owning 2 mutual funds is not diversification, it's stupidity. Diversification is when you're wealthy. Focus is the way that you get wealthy with things that you know and that are aligned with that investor DNA that you have. So risk is in the investor, not the investment. So what's a good investment for one person might not be for the next person. All right, back to this thing I was talking about. 3 ways to live within your means. 1 is you can budget. 2 is you can be more efficient. There's a few ways to be more efficient. The first way was the IRS. We're going to emphasize some time on that. And if you want, I can speak faster. Just let me know by giving me a thumbs up. Second was interest. Pay less in interest by having the right kind of structure that gives you the best types of deals, the right types of connections, like with private bankers or the right types of investors. And then third, we're talking about investments. Protect the downside. Look for non-performing fees and remove those, like a financial detective. Because here's the deal. If you had $1 million, or let's say $100,000 sitting in a retirement plan, and they show you earning 10% for the next 30 years, that grows to $1.74 million. That sounds awesome. It's never going to happen, but it sounds great. But let's say you had less than 1% in fees, 80 bips, 0.8% in fees. that $100,000 grows to $1.4 million, which is $340,000 less because it's exponential and logarithmic. But they want you to think in percentages rather than the bottom line dollars and cents. So I want you to remove drag. I want you to stop investing in things you don't know, invest more in yourself and into things that cash flow rather than accumulating and setting things into plans that you might never touch. Look, when my grandma turned 70 and I said, Grandma, you got to take money out of your retirement plan. Otherwise, there's a required minimum distribution that charges 50% penalty plus your normal tax rate. It was the first time I heard her say the F word. Not the last. I mean, once that dam broke, it was over. It was over. But she was mad. Because if you hate paying tax today, you're not going to hate paying it less in the future. So the fourth I is insurance. A lot of people have duplicate coverages, improper structure. They don't know how to properly transfer risk, and they buy expensive insurance, which are things that insure inconsequential things you can afford on your own, and they don't transfer the catastrophic things. So I'll say that clearly. You only use insurance for catastrophic risk, never anything inconsequential. Inconsequential is you can write a check today and go to sleep tonight, and you're not going to lose sleep. Inconsequential. Those are the things that cost the most because the first dollar you pay for insurance is the most expensive dollar. The last dollar is the least expensive because it's the least likely to occur, but the most damaging if it does. Does that make sense? I can go. Some people are staring at me. Okay, cool. You would just look mad, sir. I was making sure we were on the same page. Okay, so we got 3 ways to live within your means. I've covered 2. You could budget. Budgeting sucks. Or you can be more efficient within your means. Or you can expand your means. That's why you're here. That's what these guys are amazing at doing, is helping people expand their means, add more value, serve more people, make more money. You're not just looking about what you can hold on to, because when people get stuck in scarcity, they often lose sight of what they can do to provide value for others, and they only think about what they could do to survive for themselves. And as I said before, no one shrinks their way to wealth. Okay, so there's the framework. We've told a few jokes. We've got a few philosophies. Now let's get super practical. I want you to draw 2 vertical lines so that we basically have 3 buckets. On the left bucket, I want you to write team. The middle bucket, I want you to write deductions. And on the right-hand bucket, I want you to write reclassification. I'm going to give you a tax framework. It works in any country, but I'm going to tell you I'm only going to talk about US-based tax strategy because otherwise it's just going to take too long. Is any Canadians here? Yeah, fuck Canada. We don't even have to do anything. Oh, there's one. I just came back from Muskoka. I was there last week, and someone told me that Muskoka was the Hamptons of Canada. It's like the Hampton Inn of Canada, is what I thought. So anyway, I'll make sure to add some A's in process and boots and apologize every so often. Sorry for the negative comment. Okay. So let's look at the team. There's really up to 4 people that are going to be essential for your tax team. And this is the easiest thing to understand, sometimes the hardest thing to implement. The first thing is whoever's going to help you with data. This might be a part-time bookkeeper if you're a smaller business. It might be a full-time bookkeeper. It might be a controller that's handling payroll. Or it might be a CFO that's creating pro formas. But what I find is people don't have timely data. They overpay on their taxes. And we did a survey where we talked to 117 clients, and 107 overpaid their taxes that we just randomly called clients that we were working with that year. So 107 out of 117 had overpaid. The average overpayment was like $11,430 per $250,000 of revenue, so it was substantial. The second place on the team is a tax strategist. And a tax strategist is very different than a tax historian. Tax historians are the ones that say, you had a good year, here's what you owe. It's smug and it's going to piss you off. A tax strategist needs to meet with you at least quarterly through the year to say, how can we navigate this tax code? Because the first 300 pages of the tax code say why you have to pay taxes as a W-2 employee. The next several thousand pages say, here's the tax-free roadmap that you don't have to pay if you're providing value as a business owner. So unfortunately, if we look at the accounting world, they're trained in a reactionary state. They're looking to acquire new clients and file taxes, for them, and often that's what they're doing is filing taxes and not strategizing. So you might have a CPA that's a historian, and someone else might have a CPA that's a strategist. Here's the verbiage of a historian. Here's their favorite statements. Tell me if you've heard this one. I'm conservative. Let me interpret that. I'm antiquated. I'm lazy. You are going to pay too much in tax, but I want you to be scared of the government and the IRS, so you'll stay with me. Jeff, is that fair? You were in D.C. for 5 years as what were you, a tax whatever? Tax lobbyist. We have a damn tax lobbyist here. So he was lobbying for you to pay less tax, so I like that. All right, so that's some of the verbiage you might hear. Or, they'll say stuff like, well, you can't write off a home office. Yes, you can. It's right there. I could show you. It's black and white in the law. Or I'll say, hey, you should use the Augusta rule. What's the tax code on the Augusta rule so that they can write that down for the people who don't believe it? 280 HG, AG, 280 AG. And what that says is you could rent your home out to your business for 14 days a year, write it off for the business, and not claim that as personal income. That would also work if you rent it out to someone else, and that money would come in tax-free. Yet I find most accountants don't know that. So the tax strategist is going to be mostly responsible for bucket number 2, called deductions. Okay? The third person on the team, and this depends on your size as to what type of person it's going to be, but it's going to be an attorney. I know Jeff said he didn't like talking to attorneys. I was telling Brian, who's going to speak tomorrow, and an amazing guy. Actually, I actually read the book on your table. I thought it was an amazing book. I actually endorsed it. Don't know if my endorsement made the book, but I endorsed it anyway, and it was the only book I read that year, so I was really proud of myself. Thanks, Brian. I write books. I don't read. I'm not paid to read. Nobody's paid me for that, so yeah. So the third one is an attorney, and that's either going to be a corporate attorney if your business isn't doing $1 million of revenue, or a tax attorney if you're doing more than that. Like, what would you say? $650,000 of net income would probably be the threshold of where you start considering a tax attorney. Now, for me, Jeff is the one that's he saves me 6 figures a year in tax. I know he didn't give a tax talk. They said, Jeff's not entertaining enough to do a tax talk, so you talk on tax even though he knows more than you about it. So he looks like Norm Macdonald, just not as funny. So I don't know why we're friends, because all I do is give him shit all the time. But a tax attorney, for me, is about 2/3 of my tax strategy. The tax attorney is going to be responsible for the reclassification bucket, where the most major things are. Look, you can write everything off in your life and then not be able to get a loan. You can write off so much in your business that if you ever try to sell it, it looks like it was a place where you just stole money from every single day, and a lot of business owners do that. They treat it like a lifestyle rather than a business. But I make sure in my business, I'm not able to do anything an employee wouldn't be able to do. So I don't have a business credit card that I just charge. I don't pay for a car out of the business. I have a different entity that I do those types of things out of without partners, and that is never going to be sold because it's just my intellectual property company. So ultimately, the tax attorney is going to be really helpful. And then the fourth one, most of you probably already know if you own commercial property, is a cost segregation engineer. So you can look at doing that cost segregation study, accelerate your depreciation. If you own any commercial property, I would definitely look into that. I'm sure there's like 100 people here in the room that could tell you about what that is. All right, so that's the team. I like to have that team on the phone, and when I'm on the phone with them, we actually have a call coming up next week that Jeff's on, and what I do is I think like an entrepreneur. I'm not talking to the IRS, and we're not actually going to implement everything that I talk about, but on that call I'll say, headed to Italy, I'd like to write off the trip. They giggle, they laugh, I go, no. Like, let's think about it. Here's the number of clients that are coming over the 2 months while we're in Italy. So even though, they're friends and clients, I'm going to do an immersion. Sometimes I do like 10 immersions a year where I'll meet with someone one-on-one. I did an immersion while I was there. I said, let's go to where my family was from and film, and then that could be part of this documentary thing that we're doing. And by the end of the call, 55% of the trip's a write-off. So when they say no, I'll say, in what instances or what businesses could this be a write-off? And what's the coolest thing that you've done for a client since we talked last? Is there any new updates or rule changes? And what you do is you just brainstorm, and then a lot of it gets thrown out. Like we were brainstorming with Jeff once, and he's like, well, you're going to do this renovation to the office. Your father-in-law is a contractor. You could pay him at his tax rate, and you'll write the full thing off, but then his income will be less, and then he can gift that money to you. And I was like, that's a good idea. It's just not what we're actually doing, so I don't want to be unethical. So thanks for the unethical advice, Jeff. No, but this is the thing. We're just brainstorming on the call, and then we're deciding what's real after the call. And I remember the tax attorney on that call said, well, Garrett, sometimes you just make a lot of money, and you should get used to paying taxes. And guess who hasn't ever been on the call again? Yeah. So, all right, so that's the team. Let's move to this next bucket of tax deductions. So if you're a business owner, anytime you spend money, number one, I want you to document all your spending and just ask this question. Could this relate to my business? Not does this, or is this definitive? Could this relate? I bought a Can-Am. Anyone know what a Can-Am is? Like super fast, go-kart looking, Batmobile looking things, you know, that none of my family will ride with me because they're a bunch of pussies. So, sorry, I don't know if we have like a no swearing clause in this thing. Okay, cool. Because I just signed a speaker agreement for later this month where they said no swearing, and I was like, okay, got it. So I get on the phone with them, I'm like, can we write this off? They laugh again. I said, no, look, I host my immersions at the cabin. We can take people for a ride in it, and at the beginning of my podcast, we have video of it, so it turns out we could write off like 50% of it by the end of the phone call. Again, you want to have these conversations and then say, can I write this off, or in what instance could I? I remember I was doing a lot of videos, and I said, hey, can I write this off because I bought these clothes and all this? They said, no, that's not an official uniform. You can wear it out every day. I said, yeah, but I'm pretty sure all these Hollywood movies, they're buying stuff and writing it off, and it's just regular clothes for the most part. They said, yeah, but they're a production company. And I said, great. My intellectual property company will change the operating agreement. It's now a production company because it's producing videos all the time, and now I could write it off. So classification will matter in those instances. So number one in deductions, we're saying, okay, where are we spending money? And then number two, could this relate to my business? And then you talk to them on a quarterly basis. So I wrote down some other deductions that I think everyone should consider. How many people in the room have W-2 employees by a show of hands? W-2 employees. If you have W-2 employees, the employee retention credit has been sweetened. It was $7,000 for the year 2020, and there were some qualifications, like you had to be impacted by COVID. But now it's basically, did you sneeze once in 2021? Great, you're now qualified for it. And it's now up to $21,000, I believe, for 2021 per employee, plus the 2020. So we just had a dentist get back $500,000 for employee retention credits. So did you keep employees during COVID? Are they W-2? That would be something to look into as far as deductions go. And again, here's the deal. Do you want connections on how to do some of these things? All right, so I'm just going to give you David's personal cell number because I just for a decent time, you can call this. But I'm happy just to make the connections on some of these things so that you can implement what we're talking about. I mean, I'm actually not really in the financial game at this level anymore. I sold my business last year so people could laugh at my jokes, which feels a lot better than apparently making shitloads of money. So that's what I decided to do. David is about to have a baby next month, so he won't be sleeping, so he should answer his phone at all times. The phone number is 385-887-3587. 385-887-3587. David Gowns, why don't you stand up? You should see, he's the one with the shiny head over there. So, all right. The other thing is R&D credits. If you've done anything with technology, you've built a website, you've adapted your your database, your customer, you have an app or any of that kind of stuff, and you did it here in the United States, you can go back and get credits. It's beyond what you've spent. It has to do with time. So I got back $91,000 doing this, just going back, and you can amend returns, because if you've missed certain things, you can go back and get them. Some things when you miss, tough luck, but other things, you can get the money back. Every now and again, people say, well, is that going to draw a red flag? I'm like, you're showing them why you're getting it back, and they're paying you. I don't, has that ever caused a red flag or an audit, as far as you know? I mean, first off, I'm not going to teach you about offshore strategies that are going to raise red flags. I just believe in doing the legal and ethical things within the law to the highest degree. So I've been audited twice in my life. I've never been to an audit because that's the first rule. And I got money back in one of them, and the other one I owed nothing, because my plan is to always, we're super organized. My tax team talks to them, and they go on the offensive. Hey, we didn't write this off. Do you think we could write this off? Hey, we didn't write this off. Do you think we could write this off? And guess what? Sometimes you get to write more things off. I actually got in a bet with one of my clients because he told me he had the best accountant in the world. This was his words. I have the best accountant in the world. I said, really? You live in nowhere, Illinois, and you have the best accountant in the world? He says, yes. I said, well, here's the deal. You're a Bears fan, so if you'll just meet with our accounting team, we're going to look back 3 years and see if we can amend anything, and we're going to see, moving forward, what might be missed. If we don't find anything, I'll take you to the game, and I'll take you to a steakhouse. We find something, then you'll take me. So we found $100,000 going back. He had a commercial building, hadn't cost segregated. He didn't even have a corporation set up, so we set up an S corporation, let him take some salary, some dividends. That avoids self-employment tax, which saved 15.3% on some of his income. And then what else did we do? There was one other major strategy. I think it was the R&D. So $100,000 going back, and then $20,000 a year moving forward. So he then takes me to a Jacksonville Jaguars game at the very top of Soldier Stadium because he's an asshole, right? Like, I'm like, dude, that's a lot of money I got you. So 4.5 years later, we fast forward, he calls me, he says, I'm going to jail. I said, I'm not surprised for what? He goes, it's got to be for tax evasion. I am getting audited, and there's no way what we did was legal. I said, not only was it legal, you're such a pansy, we didn't save all the money that could have been saved. So if we save you more, I get 50-yard line this time, divisional rival game within the lower bowl. And guess what? We saved him, it wasn't a lot, $5,000. But there was nothing to worry about because we were organized, we had the details, we weren't doing anything that was, offshore or kind of aggressive. These are just things that are available. So employee retention credits, R&D. I mentioned the Augusta rule where you could rent out your house. Now some people say, well, I have more than one home. Can I do it for all homes? It's vague. Don't know. I've been testing it out. I have a nice cabin, and I have a house. So last year, we did write-offs on both places. I'll tell you when I get audited what they say. The reason I'm not worried is because what if they go, oh, we can only allow one? What's the worst that's going to happen to me? I'm going to pay 9%. Plus, I don't know if you guys have seen how well the government's operating right now. I'm not worried. like they sent me a letter in 2020 that they wanted to audit something that I was doing. I'm in risk management. I'm like, great, I welcome it, but here's the questions I have for you. And then I just got a letter saying there's no reason to meet. Like, I don't know why we're afraid of people that are working for this entity. Scientology's never been afraid of them. These just come to my head in the moment for you guys' entertainment. The other thing on the deduction side that I want to mention is I pay both of my kids, my 14 and 17-year-old, $1,200 a month. That's completely tax-free to them. I control the money still. I make them do the work for it, and ultimately, that's a write-off for me. So you can pay them more than that, but that's the level that's tax-free. So that's like, $24,000 write-off every single year just because the income's going to them, and I'm getting a tax deduction for them as employees. And, they're my worst employees, just by the way. I mean, they're overpaid at $12,000, but I'm just putting it into therapy for the future. So. Okay, any questions on the deduction side? So that's your tax strategist, should be really helping you with deductions. And we talked about employee retention credits, we talked about R&D credits, we've talked about paying kids, we talked about the Augusta rule. Actually, Jeff just taught me about 132J4 we were both, what event were we at? Oh, my other event I was hosting in Austin. And so I'm now putting in a pool at my house, which will be a lot of fun and a nice tax write-off. But it's fun first and foremost. I'm not a guy that goes out and gets a tax advantage first. Don't let the tax tail wag the dog. It needs to make economic sense first and then tax sense second. If anybody remembers the days of the 80s where negative gearing was going on, people are buying real estate, they're writing it off, and Reagan was like, we're not going to allow that anymore, and now they had real estate that wasn't worth anything because it was just a tax write-off. Think fundamentals, think economics, then think tax write-off, and now we're getting to the big stuff, the reclassification, that third bucket. There's really 4 parts to the reclassification. The first is if you could turn active income into passive income. And again, Jeff talked about that. Your most expensive income is your most active income, the W-2. But passive can save you tax. Even as it's simple of 3.2% on the income that's coming through in 1099 once you've maxed out FICA FUTA, but you might even be able to save up to 15.3%. So obviously real estate is going to qualify for, being more passive related income. You can differentiate your income as a business owner where you take some salary, which is considered reasonable salary, which isn't what you're worth. It's what you would pay someone else to do that job on average, not at the high level. And then that's paid at a certain level. And then you take the rest as dividends or distributions and you save yourself tax on that. So that's moving active to passive. The second is ordinary income to capital gains. So obviously with real estate, you have appreciation of that value, that's capital gains. This is where I would say it would be insane if it's anything other than a Roth, and I don't, unless you're converting to a Roth or you're not making a lot of money, you probably can't even do one. But I would never put real estate in a qualified plan because now you're taking a capital gain asset and making ordinary income. Now you're taking an asset that you can depreciate and lower and minimize and eliminate all depreciation. You're merely deferring tax in that situation, not saving it. So how do we go from ordinary income to capital gains? We mentioned, one example with real estate. There's something called an 831B, and as I tell you this does increase your audit risk. And the firm you go with will be the difference of you being able to do this or not do this because it's abused a lot of times. But how many of you have heard of a captive insurance agency? So captive insurance agency means you can put up to $2.3 million into your own insurance company, invest that money like an insurance company, and if you don't have an insurance claim for your businesses, you can take that money out as capital gains. Unfortunately, a lot of people put things inside of those that they're not allowed to do, or they abuse it, and then any attorney that's working with that client, every other client that they're working with, now gets audited. So that is something that would increase your audit risk, but every Fortune 500 company has one. Even, tons of smaller companies have them. You just have to make sure to do it right. Another one is an ICDISC. If you're doing business internationally, you can move international money through an international sales corporation and pay capital gains to bring it back to the United States rather than ordinary income. All right, third piece of reclassification, tax-free. If you have a C corporation that's been around for at least 5 years and sells for up to $10 million, no tax on that. That's a 1202. That's known as a 1202. Or let's say you have a bunch of real estate and you want to eventually exit it, not just 1031 it to something else. Well, at that point, you can do a charitable remainder trust and you can donate it to your favorite charity. It's got to be real. Some people are like, oh, I'm going to invent my own charity. Great, you can do that. You're just going to be scrutinized, and if you don't do it right, it will eliminate the tax advantage. But now you can sell that piece of real estate and all the gains will be tax-free and you'll get a partial tax deduction for the donation. You can now take income from that charitable trust for the rest of your life between 5% and 50%, depending on where you invest the underlying asset and your age. So now you're finding this full amount of income off of the full asset with the tax deduction that you can use for that year plus up to 5 years later. Charitable trust. There's donor-advised funds. Let's go into the last one here, which is tax arbitrage. Tax arbitrage is a fancy term to say, I never spend $1 to save 35 cents. I only spend $1 to save more than $1. So for example, I bought a lot of artwork. I have an art dealer that will let me buy collections of art for 25 cents on the dollar. After I've held that art for 3 years, I can donate it to museums, and for every dollar I spend, I get $2 back in tax. That's tax arbitrage. Now, it has to be a legitimately appraised asset. It has to be an actual place that you're donating. I've donated to a bunch of universities primarily that have museums, and then I get invited to stuff I never go to, right? But it's pretty cool that I can actually display it, use it, and then I can donate it. You guys are in real estate, you probably know a lot about conservation easements. Now, I know there's a lot of syndication where people come and do those, and they get with unrelated parties. But you might have property that you go, hey, I never want to develop this. If you give up the development rights, you can get tax advantages based upon the value of that development right collapsed right now. Now, if you go do that with unrelated parties, that's where it gets a little bit more complicated, and yes, you're more likely to actually get audited. Historic easements. You can buy a historical building, and you can actually protect the facade, get a tax advantage for that, but still rent that out. What you're doing is promising you'll never tear it down and change the historical nature of that building. So these are all tax arbitrage things where those kind of things might even pay for the real estate as is. Like I have 44 acres outside of my cabin where I've been trying to get the city to approve certain development for it, letting them know I'm not going to develop it, I'm just going to do a conservation easement, but if they'll change the development on it, I can pay for the land and get it for free with all the tax advantages. right? So those are some of the things that you can start to look at. So hopefully this framework helps you. The proper team, number one, the proper deductions, we're using a tax strategist, and the reclassification that the attorney helps you with. The type of corporation you use matters. Like an LLC or an S-Corp or pass-through entities, you can't retain earnings in those. LLCs that don't have partnerships aren't always the thing that make the most sense unless you're holding real estate in it. C-Corps, you can retain earnings in that kind of thing, but your type of corporation will impact your taxes. And a lot of accountants say, well, you don't need to set up a corporation only because they're not attorneys. You want an attorney and an accountant. Let the accountant help you with deductions. Let the attorney help you with asset protection and reclassification of income. Now, I recommend, as I mentioned, every 3 months that you meet with the tax team. It doesn't have to be for very long. You're going to brainstorm. But every 3 years, get a new set of eyes on your taxes. Because if you have the best team, like my friend pretended to have out of Illinois, even if you have the best team, they kind of get used to you and your situation, and sometimes this different set of eyes might come in and say, hey, did you know about the net operating loss changes that came out during COVID? Where instead of going back 3 years, you can go back 5 years, and if you had higher operational expenses some of the years and higher profits, you can mix and match. So instead of getting capped out at 80%, you can run that against a different year. So let's say that you had like $1 million of expense, and that year you had $1 million of income. There was $200,000 you couldn't write off. But if the next year you had more profit, you can actually say, well, I'll put those expenses against that year, and then mix and match and actually get more write-offs. That's a net operating loss structure that would be very helpful to go back and amend returns and get the money back. I like doing my last speech a little bit more, up here acting like a jackass and playing guitar and spoken word, but I want to make sure to give you guys some practical things so that, you can make a bunch of money, re-up, and then they'll have me come do comedy or something in the future, All right, so quick review. Oh, and I don't really make shit when people buy books, but I like to help people. So this book comes out this month, my sequel to Killing Sacred Cows. Who read Killing Sacred Cows? Who bought it and pretended to read it and just didn't read it? Yeah, good job, Tim. Yeah, so you guys are assholes. Nobody's bought or read my books. Even though I admit I don't read books, it's fine. But yeah, this book comes out this month. It's the sequel to Killing Sacred Cows, which Killing Sacred Cows is about 9 financial myths that people buy into that really harm them. 3 of the major myths they have is high risk equals high return. That's not true. If you're good at risk management, you can have more sustainable wealth. And high risk is, I don't know what I'm doing, I'm giving it to other people. That's high risk versus, hey, I'm going to learn things myself and be in a group like this.
Excuse me for just a second. I know I'm interrupting your video, but it's because I'm really excited about this. Disrupting Sacred Cows, my newest book. It's new, it's fresh. It's about all of the things that have to do with our relationship to money, the things that hold us back, and how to, kind of peek into that, be able to resolve that. And ultimately, with the new economy and everything that's happening and moving so quickly, it is timely to help you to have more success in your finances. So go ahead and click the link if you want to grab this book and dive on in.
You're in it for the long haul. You never hear that about anything good, do you? Long haul sounds like condolences. Like, oh, sorry that you went to Vegas and lost all your money, but don't worry, you're in it for the long haul. Oh, you don't want to get a call from your mechanic or dentist telling you're in it from the long haul. Why the hell would you want to hear that from your retirement planner? You wouldn't. The only people in it for the long haul are truckers. That's one long haul you don't want to make. It's all speed and hemorrhoids pushing through to get to your destination. Guess it kind of sounds like retirement, right? Like high risk equals high return. Was that just some like drunken Wall Street idiots that came up with this idea? Risk means chance of losing. How does increasing your chance of losing help you win? It doesn't. Long haul, high risk equals high return. Or how about the notion it takes money to make money? You guys hear that all the time? I'm sure some of you guys are guilty of saying it. By the way, it never takes the bank's money to make money. It takes your money. Like my son asked me the other day, he's like, Dad, how do banks work? I'm like, well, son, what they do is they rent your money by giving you a tiny bit of interest, and they turn around and rent that out to other people for a much higher rate of interest. Like, Dad, what's a tiny bit of interest? I'm like, oh, that's what your mother has every time I tell a joke. Yeah. He's like, but Dad, what happens if they lose the money? I'm like, oh, don't worry, son. There's the FDIC to insure it. An insurance company? Well, not exactly. It's the government that insures us with the taxes we pay. So they just pay us back with our own money? Yeah. Is that why they give you a lollipop, sucker? Because you're dumb, right? But like it doesn't take their money to make money. That's just a notion that people get defeated by. So killing sacred cows and disrupting sacred cows take these 10 myths or 9 myths and dispel them so that you have a track to success that says you are your greatest asset, invest always in that, not in all these things you know nothing about. You only diversify when you're already wealthy, not diversifying into things you know nothing about that derail you from the things that you're best at. And ultimately, this book talks about how we view money, because a lot of how we view money or operate with it comes with our childhood experiences that we never heal from or process. So if we've had pain or trauma, or we've heard conversations like my grandma saying, oh, people that have money do evil things, and I'm like, oh, damn, I don't want to be evil, right? And it's subconscious, but like we're about as mature with our money as we are with the pain that we have faced as kids. So this talks about how to overcome that and how to deal with that. So I don't know why I'm talking. I just am excited because I just got it. So you guys get to see it and hold it. There's only one. So we're going to have a wrestling match for it a little bit later, but none of you read, so I don't expect anyone to win, actually. So, all right. So on the tax side, just quick review, up to 4 people on the team, bookkeeper, controller, or CFO, number 1. Number 2, tax strategist. Number 3, tax attorney or corporate attorney. And number 4, cost segregation analysis or engineer if you need that done. Number 2, we're looking at deductions. What are you spending money on, and can it relate to your business? We went through everything from paying your kids to employee retention credits to R&D credits to net operating losses to the Augusta rule, all things that can immediately put money in your pocket. The third category was reclassification. How do we turn active income into passive income? How do we turn ordinary income into capital gains? How do we take active, taxable income and make it tax-free? And how do we use tax arbitrage, which means you spend $1, but you get more than $1 back? So we gave a bunch of strategies within that as well, like the International Sales Corporation. I didn't mention a couple things on this that are worth mentioning. I had this amazing strategy that was going on where I have a lot of intellectual property, and just like real property, intellectual property is property, but it depreciates faster. So I was going to have this amazing strategy. I'd been working on it for 5 years, and then Trump changed the tax laws. So I was really frustrated because it was a 7-figure tax savings, but at the same time, he created this thing called 199A. Who knows about 199A? So 199A says if you're a corporation, you can get a tax deduction that could take your taxes down to like 22% instead of 37%. So it saved me a ton of money. Jeff brought it to me. I had him get up and explain it at my last event, and then we just started calling him Harvard because nobody knew what the hell he was talking about. He's like, it's just as simple, it's this equation. And they're like, whatever, just save it for us, right? So 199A, that's something I didn't mention. We mentioned 831B, which is the captive. We mentioned art strategy. You guys are in real estate. I'm sure you know plenty about opportunity zones. But what I'm really trying to help you with here is just like think differently when it comes to tax. Maximize the savings, keep more of what you make. Think in the term of economic independence where you create enough cash flow to cover your basic expenses with assets, because when you do that, you can swing for the fences in everything else you do. Like, look, my wife, her money persona is the planner. So the planner's a stable, thoughtful, and strategic person. They want to know details and facts, and they want to like think through everything, and they want it to be safe and secure. Me, I'm a creator. I'm always about, hey, what can we do to grow and innovate, and I want to reinvest in this and build. And so when we understand each other, what happens is she's really good at making sure that we stay on the tracks, and I'm really good at accelerating onto those tracks when we work together. But what happened is as soon as I became economically independent, we became economically independent, no longer did my ideas matter in how long they took. When I'm like, hey, I want to become a comedian, she's like, great. And the reason she could say great was not because she thought I was funny, because for years I would tell her, babe, I think I should do stand-up comedy. She's like, babe, I don't think you're as funny as you think you are. I'm like, babe, you don't even understand. Every time I speak at events, they laugh. She goes, they're being nice because you're making them money. Then one day she made the mistake of saying I was kind of funny, and I heard, you are a god of comedy, and switched careers at that moment. But ultimately, because we're economically independent, she knows kids are getting the same schools, we're eating the same quality of food, we're living in the same home, we're driving the same kind of cars, we're taking the same kind of trips. Once that's handled and she feels safe and secure, she's yelling, she's like, let's go. I'm your biggest cheerleader. What can we do? Because she knows it won't infringe upon our lifestyle. But when people don't have economic independence, now their choices come down to, okay, we got this coming up, and how much time and effort am I going to have to put into that, and how much is that going to cost, and then your significant other knows it's going to cost more than you think it is, and all that kind of stuff. So it becomes one person's on the brakes and the other person's on the gas, and it's like stop and start. I'm telling you, the reason, I pivoted massively. I had an intuition, November of 2020, that it was time to sell Wealth Factory. I'd been in finance since June of 1998, but it was I know there's more for me. I can reach the masses because entertainment is the gateway to transformation. Entertainment is the new language of education. Only millions want to be educated, billions want to be entertained, but everybody's in pain when it comes to really learning about the principles of life and living an extraordinary life that they love. They're just tolerating life, trading time for money, and it's this really annoying bullshit thing that people are stuck in. And I was like, look, it's fun working with wealthy people. We do a good job with it, but you know what? My guys in business are more built for it. And you know what? I sold the business officially June of 2021, and it's grown since I sold it. I've written 4 books now since I've sold it. It took me years to write that. I did a comedy tour because I freed up my life to be the most fulfilling in who I am. So what is your life about? What life would you like to lead and live that leaves you inspired? Like creating that life you don't want to retire from. Finding a way that every day feels like a mix of play and work, and it blurs the lines, and it's almost confusing because when people see you, they just see you're engaged in what you do. Not sacrificing who you are for the one day, someday that will never come. This notion of retirement is bullshit. Do you guys even know the definition of retirement? It means to take out of service, like something you do to a cow behind the barn. Like when they retire a player's jersey or an airplane or a vending machine, that's not good news. Means it's not useful anymore. It's like, hey, Mom, what do we do with Dad now that we're not using him anymore? I don't know, I guess we can put him in that spare bedroom by the treadmill no one's ever used till he dies. Sounds kind of dumb to wait to be happy until you're useless because of money. Master that plan. Create economic independence. And most importantly, if you find the money you're tipping the government with, that's money that can build that out so much faster. What I'm teaching you doesn't take 30 years. That is the accumulation model of financial planning, and it doesn't work 95% of the times. 95% of people at age 65 are not financially independent. It's not a lack of effort, it's the wrong philosophy. Instead, I believe there's 5 ways that you get there fast. Number 1, you plug your financial leaks. We talked about the 4 I's. Number 2, you engineer wealth. What amount of money do you need every single month to cover your basic expenses? Let's reverse engineer and build the plan to get there. Number 3, accelerate investment income. Forget accumulation and create cash flow. Turn that cash flow on so it covers your expenses. Number 4, scale your business revenue. You can invest in your business and get a 50% rate of return. Stocks are not going to produce that. Small businesses have room for growth and you have more control over it. And then number 5 is make it count. Create a life that you enjoy so you're more energized every single day. Take time off. My income grew the most it had ever grown in 2017 when we took 63 days and went to Italy. 63 days, I only worked 5 half days. The first 2.5 weeks, I'm going to admit, were brutal. I was addicted to work. I watched our Slack sales channel go down. I'm going, oh my God, what's happening? And you know what? My team grew up and figured it out. And I started to drink Aperol Spritz, which are beautiful, and I started having the 4-hour dinners, and I learned about cappuccinos, which I had never drank before. I'm now an amateur rookie barista that I make wonderful lattes all the time. I came home, I picked up the guitar, I had a vision to do the one-man show that many of you guys saw in Vegas. That came from having a hobby and creating space in my life. Don't let money be your reason or excuse for doing or not doing something. If it does, it's the master over you versus you being a master over it. So the question is, when are you going to take that plunge and take the leap on yourself, get your financial house in order where it doesn't create stress and scarcity so you can live a more abundant life and get past the place of survival into thriving and inspiring others to do the same? So look, I've never said this from stage before. I've never done this, but this is my 3rd time back to this event. And so 10 times a year, I spend 1 day with someone. I just immerse with them, help them save on tax, help them to get their financial house in order, help them think about their life and their vision. Ends up being marriage counseling, which somehow now that I've been married for 20 years, I'm a quasi-expert on it. I'm now officially an expert on a speech giving. I am a best man in 3 weddings this year. Not because I'm that good of a guy, I'm just a fucking good speaker. And they're like, he is going to nail this speech. Now, it's also concerning because of my comedy. They're like, oh shit, is this going to be a real speech or is it going to roast me? I'm proud to say I did not roast my best man, or the guy I was the best man for last week, and I'm hoping not to do it for the one coming up in October, but I can't promise anything. But if you're interested in spending that day with me, like I only have room for 5 people. Like I have one next week, one the week after. I just do 10 a year. But you can just text David. And if you want Jeff to be there and do an extended day, I can talk Jeff into coming. We went hunting last year. He somehow still hangs out with me, even though I just relentlessly tease him. But it's amazing what a referral will do. I can do 10 jokes per referral, so it's a party for me, right? But if that's interesting, come and talk to us. If you want to know what that looks like, I mean, it's usually a lot of money in people's pockets because I have all the connections and I just make them for you and we plan everything out, and it saves you 10 years of trying to do this on your own or with a bunch of financial planners that don't get it or that try to talk you out of real estate. That's your business. That's what you're good at. I'm not going to talk you out of that. That's your expertise. I want to build something that supports that and accelerates that and puts more money in your pocket, and most importantly, help be the advocate to convince you to invest in quality of life. Quality of life is worth it. Like I bought a cabin, what I thought was at the peak of the market in 2018, because I wanted to bring a slice of Italy to America. And then I got into fly fishing, and I became a whiskey sommelier. And yes, it's just as douchey as it sounds. I have a big dumbass medallion I can wear while I teach you about whiskey, because I can't keep up with you wine snobs. It's just impossible. Right? I got tobacco pipes up there. We got the Can-Am. We got a pool table. Like, it's just this place. It's a sanctuary. And I bought it to create legacy today, not as something I leave behind, but something I live along the way. And I've been rewarded with this beautiful appreciation of people exodusing California to come to Utah, you know? I mean, California is one of the states that has the best weather, some of the best restaurants, the best beaches, and people are like, fuck it, I'll live in Texas. Like, how bad do you have to be like, you know what, I love the humidity of Austin. The traffic reminds me of Southern California, so why not go there? Sorry, Texans. If you can invest in your relationships, that's the currency of the future. If you can invest in your quality of life, that's what matters. But you know what? Find the money so you can have the help. So you can hire out the things that you're doing that are draining your energy and taking your time. And before you just go into scaling the business the next day, scale your quality of life first. Find the things that you love, spend more time with the people you love, and live the life that you love. Thank you.
You know what's worse than learning about tax? Is overpaying tax. Now, I get it. Most of the time it's drab and boring and you'd rather do about anything other than tip the government. So I've taken all this enormous effort into making it more enjoyable, more pleasurable, actually making it funny at times. And it's a very serious topic, so I'm seriously going to put more money into your life, less into the government's the most legal and ethical way possible. So if that sounds good to you, go ahead and check out the next video.